Getting started in the stock market can feel as overwhelming as navigating a labyrinth, but it doesn't have to be. From understanding the basics of stock trading to mastering investment strategies, it's crucial to equip yourself with the right knowledge. How do you know where to begin in such a vast field? And with countless options available, how do you decide which investments will yield the best returns? Here is your ultimate guide to get started with the stock market. When thinking about your financial future, it's important to consider how to make your money work for you. Investing is one way to do this. By buying and holding various investment products, you can give your money a chance to grow over time. This growth can help you achieve your financial goals, whether it's saving for retirement, buying a home, or providing a steady income. The potential increase in value from investing often plays a crucial role in reaching these goals. One of the main reasons people invest is to protect their money from losing value due to inflation. Inflation gradually reduces the purchasing power of cash, meaning that over time, your money buys less than it used to. For example, with 3% inflation, $100 today would only buy what $97 did a year ago. This loss of value can be significant, especially over long periods. To prevent this, many turn to investing as a way to outpace inflation, allowing their money to grow and maintain its value. Investing is a crucial way to grow your money, especially in times when inflation threatens to erode your purchasing power. You might wonder how much money you need to start investing. Surprisingly, the answer is not a lot. It's often better to start small rather than waiting until you have a larger sum. This is because of the power of compound interest, a principle where your money earns interest on both the initial amount and the accumulated interest over time. Starting early, even with small amounts, can lead to significant growth down the line. Next, you may ask, what should I invest in? The answer largely depends on your investment strategy. You can choose to invest in individual stocks, which involves buying shares of specific companies. However, if you're looking for something that provides diversification, spreading your investment across various assets to reduce risk, exchange-traded funds, or ETFs, or mutual funds might be a better option. A mutual fund, for instance, pools money from many investors to buy a mix of stocks, bonds, or other securities. This is often referred to as the eggs in many baskets approach, reducing the risk that comes with investing in just one stock. When it comes to how to invest, there are several paths you can take. If your goal is to save for retirement, contributing to an employer-sponsored retirement plan, such as a 401k, is a good place to start. These plans often come with tax advantages and sometimes employer-matching contributions, making them a powerful tool for retirement savings. If you don't have access to a retirement plan through your job, an individual retirement account, or IRA, is another option to consider. On the other hand, if you're looking to invest money you might need in the nearer future, opening a taxable brokerage account is a straightforward way to start. These accounts allow you to buy and sell investments like stocks, bonds, and ETFs. One of the most common questions new investors have is whether there's a secret to making money in the stock market. The truth is that staying invested over the long term is key. The stock market will inevitably experience ups and downs, but history shows that staying invested through these fluctuations usually leads to positive returns. This approach requires both time and temperament, the ability to remain calm during market volatility. As famed investor Warren Buffett advises, the best strategy is often to be patient and not to panic when others do. Investing can seem overwhelming, but here are 4 ways to start investing in the stock market, arranged from most risky to least risky. Individual stocks. Investing in individual stocks means buying shares in specific companies. When these companies do well, their stock prices go up, and you can earn money if they pay dividends. However, if the company's stock price drops, your investment value also decreases. This makes investing in stocks one of the riskier choices. To handle this risk, you need to research each company thoroughly, stay updated on market trends, and be prepared for potential losses. Diversifying your investments by holding shares in different companies and exploring other investment types can help reduce overall risk. Mutual funds. Mutual funds are investment vehicles that pool money from many investors to buy a mix of stocks, bonds, and other assets. Each mutual fund has a specific focus, such as investing in a market index like the S&P 500, a particular asset class such as bonds, or a specific sector like technology or energy. Some mutual funds also focus on ethical or socially responsible investments, which follow certain environmental or social guidelines. One of the advantages of mutual funds is that they offer instant diversification. Instead of buying individual stocks, you get a pre-packaged collection of investments managed by professionals. This makes mutual funds an easier way to spread out your investment and reduce risk. Index funds. Index funds are a type of mutual fund that tracks a specific stock market index, such as the S&P 500. These funds aim to replicate the performance of the index they follow. They offer a good option for beginners and those looking to balance their risk. Unlike actively managed mutual funds, index funds are not frequently bought and sold by managers, which leads to lower fees called expense ratios. These lower costs can improve your overall returns. Index funds provide broad market exposure and can be a solid choice for investors seeking both growth and stability. Exchange-traded funds. Exchange-traded funds, or ETFs, are similar to index funds in that they bundle various investments including stocks, bonds, and other assets. What sets ETFs apart is that they trade on stock exchanges like individual stocks. This means you can buy and sell ETFs through the trading day at fluctuating prices, often for less than the $500 or more that many mutual funds require. ETFs offer flexibility and affordability, making them a popular choice for investors who want a diverse portfolio without a high initial investment. So should you invest in the stock market? Investing now means your savings can grow over time, potentially increasing in value. Historically, the stock market has provided the best returns compared to other investments, with an average annual return of 10% before inflation. This outperforms most other asset classes. However, many people worry about the risks or feel unsure about how to invest. These concerns are valid, as investing does involve the risk of losing money. Yet by creating a diversified portfolio, you can better manage these risks and improve your chances of reaching your financial goals. Diversification helps protect your investments from major losses during market fluctuations, making it a strategic approach to long-term success. Getting started in the stock market is all about understanding your options and taking that first step. With the right approach, investing can be a powerful tool for building wealth over time. What investment strategy are you most interested in? If you found this video helpful, don't forget to like, share, and subscribe.